Hi, welcome to session 2. In this session, we cover financial statements. So, from the most kind of complete financial statement that will be the income statement and the balance sheet to a very specific one that is the cash flow statements. We will try to see how they are produced, how they are structured, and also what should we be looking at when we look at financial statements. As I was saying, we will focus in 3 of them. There are more financial statements, but we focus on the most important, most commonly used. Balance sheet, income statement, cash flow statement. Before we look at the specifics of each of them, it's important to take into consideration why are we paying attention to financial statements and why are they important. The main objective that we have is to understand why the information that is in there can help us to understand what is going on inside the organization, and also how the information that is contained in those statements can help us to maybe make decisions or also propose or suggest changes inside the company. We will not go into detail into the accounting rules or standards that are behind this reporting process. If you want more details, you should look for that. It's an interesting area, but it's probably more interesting for those that are interested in learning more about accounting or reporting of financial statements. So we start with the first one, the balance sheet. What here we are looking is that it's basically and broadly structured in 3 main blocks: assets, liabilities, and equity. On one side, we will always see the assets. In some way, you can call it like what the company owns. Owns as that it belongs to the company. It can be physical things, but also non-physical things, as we will see. On the other side, we will see liabilities and equity. This is in some way to show how did the company acquire what it owns, is because other people, other actors have helped them to get those resources, and then the company owes to them. There is a simple rule: assets should be the sum of liabilities and equity. So what happens in situations where assets are decreasing, then either liabilities are also decreasing or equity has to decrease to keep it in balance. And that's also an accounting rule that you will see that we always stays in place. Let's try to see a bit of detail. So what is behind each of those different elements? Inside the assets, what do we find? Let's start at the beginning. The first thing that we will find is the current assets. Those are elements that can be converted into cash with 1 year or less. So it's those things that are very close to become cash. The first element that we will have here, as you can also imagine, it will be just real cash that is in the bank, in the company account. But also there are other things that can be expected to be converted into cash quite soon. This is account receivable. The concept of customers that may be placed an order, we deliver the products, and they are going to be paying in the next months. Or also an inventory can be part of these current assets. So the company has some stock of some finished products that are ready to be sold. Or even maybe it has some raw materials that in case they need money quick, they can also sell them and then get them converted into cash. But there are other types of assets. The next point is the non-current assets or long-term assets. Those are things that the company owns, but it needs to stay alive and to stay operating. But those are not things that will get out of the company in the next year. So those are, for example, physical assets. It can be the property of maybe a plant that they have or the offices that they own. And most of the times what here we find is equipment that is necessary for production, for research, for other things that the company does. As you can imagine, machinery is part of this. Here a first concept comes up, that is that physical assets will have to be subject to depreciation. So we need to have a rule on how we depreciate those assets, because even if they are fixed, even if they are things that the company owns and needs for the long run, they also lose value. They deteriorate with time. And at some point, they have to be renewed. So an accounting convention is that you have to kind of auto-program those assets so that they lose value every year, so that you kind of save some money from the company so that you can use them in the year when you need to renew them, and it doesn't have a huge impact at that moment. This is the whole concept of amortization and depreciation of the assets. Other types of assets that we might have, it's intangible assets, internally created or purchased. There are some differences between accounting standards. Here, in some places, for example, the R&D projects, you can at some moment activate them as assets. And when they have advanced or you have gone through some milestones, as an R&D, it can become an asset. In other places, this is not allowed. But what you might find, and this can sometimes surprise people, is that there is an asset, for example, that are brands or brand reputation or customer reputation. And this is usually packed behind this goodwill concept. This only happens, and this is a strict condition, only happens when you acquire another company. This is the difference when you acquire another company between the net asset value that you are bringing in, or the net liabilities, and the value that you are paying. So this difference is like what maybe the business, you would say, business value of that company or the reputation that they have. And this, you don't have any other option, as the company is giving away cash for that new company to have it merge or to acquire them. Sorry, in this case it will be acquire them. Then you need to report this in some way as something that you overpaid, but actually that it should have that value, and you call it goodwill, that extra value. As it's mentioned here, it's subject that at some point in time you might realize that that acquisition was not such a good idea, and it gets reappreciated, or in this case devaluated, and it loses value. A company that was famous for doing terrible acquisitions during some time was HP, that overpaid for other software companies and firms, and then they had this huge impairments in their reporting that they have to declare that actually what they had overpaid was not worth it. Let's look at an example, as it's usually much better than to keep talking. This is an example of Stihl holding, and you can see here, like just looking at a very nice and clean balance sheet that they are reporting. These are two kind of, one is a consolidated account, and the other one is only the pure and rare Stihl business. For us, what is important more than this small difference is that they are able to present how their assets and liabilities are distributed. And in this case, we see that this is a company, for example, something interesting that comes very quickly, that has not that many liabilities in relation to their fixed assets, inventories, and other types of assets. So it's a quite well financed, and it's financed via equity mostly. If we go into the specifics of the balance sheet, we can see that it's organized in a bit of a different way. So we see that in this case, they first report fixed assets, and then they report current assets. So they start with the more illiquid, and they end up with the more liquid. We will see in other cases, more the American standard, you start with the most liquid assets, so the current assets or cash. As you can see in this case, and you can look into the details, so you can stop the video and spend a bit of time here to see how does the balance sheet look for, in this case, for Stihl. And something that might be, for you, maybe surprising is the amount of the inventories that they have, and also maybe that they are able to still keep quite a bit of money as cash in the bank, although they don't seem to be a risky company, no? But maybe they are keeping this money for future investments, or maybe to be ready in case things get a bit more complicated and they need some cash to cover up some potential losses. Let's keep moving on. So on the other side of the assets, how have we been able to finance this? So these are the liabilities. In this case, the liabilities are things that are not necessarily negative. So it's a good thing that you have a good management of the liabilities. For example, that your suppliers allow you to pay a bit later than maybe you ask your customers. This is the perfect example of a supermarket that maybe is charging their customers as soon as they buy something, but they pay their suppliers after 60 days or even after 90 days, depending on the product category. So the liabilities are those funds that they have been borrowed by the company to be able to have the assets and to have them running. What other types of current liabilities do we have? So we mentioned now what you owe to the suppliers, but also, for example, it could be the accrued expenses. So some things actually maybe you have already used and you have already, but you haven't yet paid to those people. Sometimes this can be maybe somebody that has actually helped you to do something and you promised them that you would pay them some money in the future and you haven't yet paid out. Or maybe some materials that you've used, or maybe the invoices from your energy supplier that you might be paying next month. What other things might be in these current liabilities? It might be maybe some money that you might owe to your employees, even about commissions or bonus or other aspects. On the more classic long-term liabilities, so things that are more than 1 year ahead, will be maybe if you have been able to issue debt or bonds that you will be paying the next 5-6 years with an interest rate and so on. This would be a long-term liability. This is ideal to finance those fixed assets that also are with a time horizon of more than 1 year. You want this to be balanced so that your current liabilities at least cover your also current assets, and if you can have more current assets, also it's not a bad thing. But what you also need is that the long-term liabilities help you to cover the long-term assets. What will be concerning is that if you are using long-term liabilities to cover your current assets, so anything that here starts to be unbalanced, it's a reason of concern most of the time. The same thing is if you are using current liabilities, so things that you need to pay back very fast to finance your fixed assets, then this would not make sense, because then you need to keep finding current liabilities to finance these long-term assets. So the time horizons ideally should be balanced. There are other also less usual types of liabilities, for what we call contingent liabilities. Maybe somebody has put a claim and you are waiting for the decision on, okay, maybe you will have to end up paying a compensation, or maybe you have some commitments that if something goes in a certain way, you will be paying more money for your rent or for other things. Those things need to be also reported. The idea here, and I will not go into detail, is that we are always as much like that prudence and to be as much accurate and careful when we report those things, so that we are not hiding liabilities to our either shareholders or stakeholders in our company. So we try to disclose everything that can be a potential issue. Let's look at this example. This is from 3M, different company. And here you see that the structure again here has changed. You see that we start with assets and we start with the most liquid form of assets. In this case is cash and cash equivalents. And we go all the way to the goodwill and intangible assets. For example, they have quite a bit. That's because they've been acquiring some companies, or maybe they have R&D, the projects that they have been able to activate them. And that's why we see them here. And on the other side, we see the liabilities and equity. We were saying that the total sums in assets and liabilities plus equity need to match. You can check, it matches, okay. Then the next thing that we would like to see or quickly look is like, okay, how do the total current liabilities in relation to the total current assets? And we say, okay, this also looks good because the total current assets are above the total current liabilities. This means that they are not kind of financing or having a misalignment between the long term and short term of their structure of liabilities and assets. And we can also see that their total liabilities in this case are a bit above, in this case, maybe what they would have as total current assets and some of the assets that they will have. But this is, in this case, this company seems to have a lot in goodwill and intangible assets. So they use the long-term debt to finance a lot of their long-term R&D projects or goodwill that they've been acquiring. Here we don't have the details, so we don't know what this is. It's always an issue when we look at a very summarized or shortened report, because we don't know exactly what is behind this goodwill and intangible assets. That's something that you can also go and look more. So at the end, I just wanted to offer this chance to get a quick overview of how is this usually structured. There is a specific area on the balance sheet that is always a bit complex, is a stockholders' equity. The official way to report that is this has to be the book value of equity. So what the stockholders disbursed at the moment that they were creating the company, not actually the market value of the shares. This is important to not confuse those two things. So this shows so at the moment zero, when the company gets created, we would only have cash as an asset, and in the liability side we will only have equity, and it will be maybe 100 and 100. So it was one shareholder that put 100 euros or $100, and we see 100 and 100 on each side, and it's sums, and so it's correct. From that point onwards, all the other contributions that happen might go at maybe different share values and so on. Okay, this will need to be reported. And in some cases, there might be these additional premiums that are added as part of equity, because maybe some shareholders had to pay a bit more, but this came in also as cash for the company. This is the comment we have, that there might be this paid-in capital if we sold the stock to third parties or to other people above the book value. But this again is kind of a more specific thing that it's not so key at this moment. What are the limitations? When we look at the balance sheet in general, is that we need to understand that the whole valuation of the balance sheet in the assets and so on is done at book value. So it does not take into account how much business those assets can generate. It only shows how much did we pay for them, when did we pay for them, and how much they've been depreciated. But we are missing what are we actually doing with those assets or those liabilities. As we have mentioned, all those elements, unless you have been acquiring the companies, and then it comes up in the goodwill aspect. But all the intangible assets are not well captured. Brand value, loyalty of the customers, reputation of the company, ability to manage things better than other competitors when it comes to managing their properties or equipment. And some of the assets are captured via estimated values when it comes to depreciation, or when it comes, as we were saying, this R&D, maybe capitalization of the projects. We keep moving on. Second statement, income statement. What the income statement is, it offers you this snapshot of 1 year operating of the company, 1 year, or if it's a quarterly income statement of that quarter. So it covers a period of time, and it gives us a snapshot of how the company has been managing to generate cash and revenues. It captures all the transactions that have happened during that period of time. So it should go from sales to the costs, and then at the end, okay, what has happened after the year, how much net profit we've been able to generate. So it's a very ambitious, and that it goes from a very big number or small, depends on your total sales that you have or total revenues, to the very final number that is this net profit. Okay, what has come out from all of this? As you can imagine, the business is very different if you are looking at a company like Amazon, or if you are looking at a company like Daimler, that they sell different types of products, that the life cycle of their products is different, and that their margins are very different. Let's look a bit at the specifics of this statement. So first thing, sales and revenue. They can be reported. Usually what we do is that we report them by what we say the completed method. So as you are selling them, they become fully into account for that period of time. In some cases, you can imagine a construction company that maybe is building a bridge or a highway during a few years. Then it will be reporting that part of the total project that it has finalized and delivered during that period of time. That's what they mentioned, this percentage of completion method. This is not the most usual, but it happens. And the same might happen if you are on the process of selling maybe a software solution to a company. You need to define whether you will wait and then it reports as the first sale in the next year, or you report it as, okay, we've delivered already 50% of that consulting project or implementation project, and I can already put it as part of what I've done that year. What is the next thing that pops up is the operating costs. This is the most clear and direct costs that I have to produce those sales. So ideally you are thinking about the materials, the salaries that are behind, even the selling or admin expenses, and then some maybe adjustments that I have to do to the intangible assets that I have had. Important here. R&D expenses can be salary, cost of tech components, cost of test equipment, and so on. Here, just be careful. It's not the cost of the equipment I'm using. It's cost of maybe some running expenses that I have, because the cost of equipment is something that we have in the balance sheet, and it's an asset because it's used during more than 1 year. On the selling and admin expenses, anything that is related to the staff that I have on marketing, executives, traveling, advertising, customer service, IT costs, all those other things, and even overheads. So the people that I have, that they are working for the company, that they might have an indirect effect, I still need to report this as part of my costs. These are more these indirect costs that I might be having. Also, it's important to understand that every year we are using part of our inventory of raw materials and products, so I need to adjust and control what was the inventory at the beginning, what is the inventory at the end, how much I have purchased. Okay, this is the cost of the materials. Also, I need a rule, so every company needs to set up a rule. How are we going to be managing the inventory valuation? Am I going to be doing this first in, first out, last in, first out? I'm going to be doing an average. This matters a lot if you are using some kind of commodities, for example, using water or using oils or chemical products in your company. Just imagine that you are a dentist and you are using implants, and you need to take into account that each implant is very expensive, and maybe the price changes during the year of some types of implants. Then you will need to be able to have a rule. Okay, how many implants do I want to buy and have in inventory? How do I take into account during the year that I've been buying some additional ones, which ones, and how do I do this whole costing calculation when I want to know actually how good has this year been? Because if I only look at the money that goes in and goes out, I might be missing out actually what is going on in the management of the inventory. So depending on the type of company, this is more relevant or less relevant. In a software company, you can argue that, okay, this may be not that relevant if I'm selling licenses for some type of software. Finally, at the end, towards the end of the income statement, we will see the earnings before income and taxes. We will have to pay some income taxes, and at the end, we will have this net income or net earnings. You will see that, for example, earnings before income and taxes is what there is an acronym that is called EBIT, so E-O-E-B-I-T. So there will be a lot of short versions, acronyms for many of those different concepts that we have in the income statement. Let's look again at an example. Here we are sticking with 3M so that we have a consistent reference point. Here we see, for example, that the first 3 months ended in March 31st of 2020 for 3M. They have been able to keep the similar number of sales. However, when it comes to the cost of sales, they've been able to reduce the cost of sales. They have been able to also reduce the general and admin expenses, but the research, development, and related expenses have increased in relation to what had happened in 2019. At the end, they are reporting that the total operating expenses have reduced despite having more net sales. So far, it looks positive. They have other incomes that they are not reporting here in detail. And what we see is that they have increased their income before income taxes by almost 40%. That's quite a lot. And then they have some provisions that we also don't know what is going on here. But we see again that their net income in this period of time has increased quite a lot. It's quite a nice result from their side, so it's almost a 33% increase. At the end, they are also reporting the net income that is attributable to 3M, and then they also report some things that might be interesting for their shareholders. Again, just remember, we go from the broadest number that we have, the sales that they've been able to produce. And here it's important that, for example, if you are reporting, you're a travel agency, you are here, you should not put the whole value of the trips that you are selling, but the net sales should be your commissions. So all the commission money that you brought in, it's the money that you bring in through your services or products, not maybe the whole money that you help to generate. So just be clear that sales revenue, sometimes it gets a bit mixed. So we move on to the last statement, the statement of cash flows. This is, I would say, the one that is less intuitive and maybe you have heard less about. We usually try to report three elements: the cash flow from operations, cash flow from investment activities, and cash flow from financing activities. And again, the cash flow statements is quite helpful to understand how well the company is operating and is generating those profits and managing that balance sheet. How well is this happening? Is this sustainable? Is this not sustainable? Are we doing some shortcuts? We get this information here in the cash flow statement. I'll briefly explain each of them. Cash flow from operating activities. This is the cash flow from day-to-day operating activities. How to calculate this? We get the net income and then we have to adjust for non-cash expenditures and income and current changes in current assets and current liabilities. This is to capture this working capital that we need. This is a concept that might need more attention and you might need to check some of the definitions. In the next sessions we will also touch upon this again. What are non-cash expenditures and income? It's the depreciation for fixed assets, amortization for intangibles, and some impairments or share-based compensations. How do I calculate these changes in current assets and current liabilities? You add the increases in current assets or the decreases in current liabilities in the mix. Next element, cash flow from investing activities. This is the cash flow related to the acquisition of fixed or intangible assets and companies, offsets by the disposal of such type of assets. Why is this important? Some companies have huge investments in maybe their capital, what we usually call capex. So maybe they need to keep investing in getting new assets, getting new production plants, getting new equipment. It's important that this gets captured because otherwise you will only see that the balance gets bigger, but you actually don't understand that to stay competitive in that business, you have to continuously keep investing. This is something that some software companies are used, for example, with the data centers, that they need to keep investing in the data centers in order to keep their business competitive, maybe if you're offering cloud solutions and so on. So the scalability is not that perfect. You need to keep a high level of investment every year. This is captured in this cash flow from investing activities. Finally, the cash flow from financing activities, usually not that relevant for most of the normal, let's say, manufacturing companies. Is this more related to the sources of capital funds that you are managing? This captures well if you have done, maybe you have been canceling some debt that you have been repurchasing a stock or selling a stock, maybe you have issued stock, or maybe you've been selling bonds and getting money from debt holders in this case, that they are buying debt bonds. So this is not unusual, but not the most current area where you would pay more attention. So another example that might help us here. We have on the left side an example from 3M and on the right side a very detailed example from BMW. I would suggest again that you stop the video here and you try to walk step by step. In the case of BMW, it helps a lot that you can see step by step how they have been able to move from the net profit till the cash inflow outflow from operating activities. It's much more summarized in the case of 3M on the left side. This is what we needed to cover from in this session about financial statements. Thank you.